So we'll talk about reversing entries, and this is in the appendix to your chapter, and I do cover these so that you will know what they are when you run into them. I don't go into a whole lot of detail, but you really should know what they are and how they work. So reversing entries, optional step in the accounting process. They're made at the beginning of each accounting period. Usually what gets reversed are accrued expenses, accrued revenues. What does not get reversed ever are things like depreciation expense and bad debt expense. It's usually going to be things where the cash will come in or go out at a later period than the expense was incurred or the revenue was earned. So how does this work? Let's go the sort of normal salary expense without reversing entries. So December 31st, you pay the salary. You've got salary expense and salary payable. That's to accrue the year-end salary that probably won't get paid until January 5th. So this would be the normal thing. Then on December 31st, you do all your closing entries, and so salary expense would get closed, and so would have a zero balance. Okay? Then come January 5th, the bookkeeper writes a check for $600. $400 of that goes back to the salary payable from last year. $200 is for salary expense so far for the first week of January. So that's what we have done so far. What a reversing entry does is it simplifies this entry for a bookkeeper. And so they simply have to make an entry like this. They just have to go salary, expense, and cash. That's what the reversing entries are all about. It's supposed to simplify the bookkeeping process. So how does it work? Same thing happens up here as happens without reversing entries. You have the salary expense, you've got a payable. You close the salary expense account so it has a zero balance. With reversing entries though, on January 1, the first thing you do is reverse this journal entry and go salaries payable, debit, salary expense, credit. So what does that do? That gives you a negative $400 balance in your salary expense account. So now, when the bookkeeper goes to pay, this payroll on January 5th, all the bookkeeper has to do is go 600, 600 salary expense. And what happens there, how does that end up working? Well, let's see. This is our salary expense ledger account with reversing entries. So here's December 31st, you get salary expense. December 31st, you close it. Now, here's the reversing entry. It gives you a negative balance here. So when the bookkeeper writes the check, just salary expense and cash, 600, you end up with the right balance, okay? So those are your reversing entries. As I say, they're something that you should be aware of how they, just basically what they are and how they work. And again, I'm not going into a whole lot of detail on them, but there they are.